This conference will now be recorded.
Good evening. This is Frank, Clueless Day Trading. We have a terrific new member, Adam, who joined us recently. Today is Thursday, 8:04 p.m., July 25th, 2019. This is a new member complimentary ACS or training sessions, trading session. Uh, Session will be recorded. It will be available for you to view at any given time on the Google YouTube channel, and it will be in the new member introductory video, so others can see some of those, some of the questions and some of the questions and technical stuff that we're going to go through today. Full disclosure: this is purely for financial education, not for any solicitation or advice. And let us begin. So basically, Adam, what I want you to do is to start throwing out the things that you want to know, and I'll try to provide the best possible uh, answers and explanations. And I know you had questions on chart pattern stuff from the last webinar, which we were covering trade alerts and stuff like that.
Yes,
So
sir.
go ahead. I'm all yours.
Okay, so I noticed when you put out your alerts, you
Yes.
usually will include like the name of the chart pattern that you're watching, like bull flag.
Most of the time. Most of the time. Mm-hmm.
Yes, and you do like bull flags, cup and handles, inverted head and shoulders, things like this. And I would just wanted to ask you because you've been doing this a
Yep.
lot longer than me,
Sure.
and I just wanted to ask you, like, if you had any favorites, or what is there that like
That catches my eye
you see
a
that
lot more.
yeah,
Yeah.
and that is going to have a high probability
That's
of
it.
going your way, because I've seen
That's
a lot of times where there'll be like a setup, like a bullish setup,
and it
and
doesn't
then
work out at that
it'll
time.
it'll fail. Yeah.
It'll fail. Exactly. No, that's a very, very good question. In fact, one of the best questions I've heard in a while. So let me just go through something that I've already have on my new member introductory video playlist, but let me explain to you directly some of the things which are recurring all the time. And then we're going to go through some real life charts that I put out there, some of those falling wedges and stuff that have broken out tremendously. And most importantly, we're going to look at the overall market just in the past week alone and see these what made me stay long, primarily long, and continue, and as the market, even with 200-point drops, continue to make new all-time highs the following day. So that's all going to kind of fit in. So the first thing that I want to point out to you very simply are some of the recurring patterns, and there are many. There are more complicated patterns there, but some of them that happen all the time and which are more of the higher probability ones, I'm going to mark them out. So first of all, let's kick off by looking at the head and shoulders. Okay, um, the head and shoulders pattern generally is a bearish pattern, as we know. And let me make sure I have this in here so I can draw simultaneously. 1 second. Um, and the before I actually, oops, before I even start, let me just point out one thing. And this is something that I always want to impress upon everybody. Very importantly, and a lot of people have a difficult time accepting it. The machines that run the market, as I keep on repeating like a broken record, like the algorithmic high frequency trading robots that run the market, these guys are morphing patterns or changing patterns so quickly. Some things that would have taken back in the days, let's say 10 years ago or even 6, 7 years ago, would have taken a couple of days to happen, Adam. Now it's happening in literally 15 minutes or 20 minutes.
Hmm.
The volatility that's created changes pattern structure so quickly, it makes traditional technical guys make their head spin, and they basically try to make it simple. It's not that hard, but it's not simple because the speed the market moves in, which you see every day. Okay,
Right.
down 300, ends the day, it takes back half of that gain, ends the day maybe down 100, or up 400, down 100, and then ends the day on a positive note. These recurring things that happen so quickly, it's something that we can't control. And so what happens is patterns are changing very, very quickly. Now, longer term, the key thing about technical analysis is that the longer you look at a time frame, you are cutting out a significant amount of the noise. The noise is generated primarily by 15-minute charts, the 1 hour charts, 30-minute charts, the 5-minute charts, the short term charts. Okay.
Yes.
One as an active day trader can actually make a pretty decent buck on very fast trades in that time frame. However, in order to see the overall trend in the market, you got to look at the daily, you got to look at the weekly, you got to look at the 4 hour. So let me write those down. So on a short-term basis, which is basically a lot of noise, news headlines, rapid movements, in the morning, afternoon sell-offs, and then a sharp, big buy programs that come in a lot of the days at 3:30, 3:45 p.m. The short term is in the 5, 15, 30-minute charts, okay, time frames.
Okay.
The ones which are intermediate, which is really the one can, and remember, there's no one way that, and like you said, I've been doing this so long, it's almost become second nature. So I really have to break it down to explain to somebody new, and that's exactly what I've done pretty successfully with a lot of people. So the intermediate terms are the ones which is a combination of the 1 hour, 1 hour charts, the 4 hour charts from it. These are all trading time frames.
Mm-hmm.
Trading time frames. Okay. And mix in with a little bit of the longer term view. Now, long term also changes quite rapidly because of the heavy duty fluctuations, which are basically totally machine dominated. Like I've always said, almost 70 to 80%, some days 90% of the trading in the market is dominated purely by algorithmic high frequency trading machines. So they're moving around really, really fast, and they're all different types. Some of them are day trading individual stocks. That's why stocks up 5. All of a sudden you see it pull back, especially the high momentum stocks. You see it pull back $4 within 10 minutes, and then by the end of the day it's up another $15. You see a lot with those high momentum, high beta tech stocks, which primarily move in that zone. Then you have those macro algorithmic high frequency trading funds, which tend to be big buyers. And those are the ones you tend to see their footprints. In other words, both in volume, the indicators, and the big fat green candles, you tend to see that on the longer term chart. So the longer term is designated as daily, weekly, and of course monthly. Now, as a trader, and this is where the difficulty comes in, this is where we have to really navigate. If we stick to the daily, weekly, and monthly, then we cannot generate, if you really think about it, we cannot generate recurring consistent income during the week. Because in that case, you're going to sit on something, you're going to buy some calls or buy that stock 3 months out or 2 months out with a lot of time in your hand, and you will not be able to cash that in because you're just going to basically sit with that till hopefully it gets to that level. And in between, there's going to be a lot of zigzags while it gets there. Now, the daily, weekly, so as a professional trader, which is basically I'm writing my own paychecks, I have to generate income. I'd like to have a very nice, P&L every single day. But as a straight shooter, I say, no, it doesn't work like that. What I look at is on a weekly basis, how much have I made? And that means that 2 days, maybe I could be down. I'm setting up the trades. I'm in the red. And then the other 2 days, I'm just basically shooting fish in a barrel as the markets are surging forward. Now, this is something you're going to see a lot on our service. And the difficulty comes in is that people are not setting up the trades during those, and we're going to look at that tonight too, during those periods where the screen is blood red, everything is upside down from a price standpoint, but internals are suggesting that there is going to be a pretty significant rally. Generally, that happens within 24 to 48 hours. And what I've seen, the way the markets move, especially, and it depends what level of the market we're in. We're coming in on the top end of the market right now, right? So, but when the market is coming off the bottom end of the thing, and we're going to look at that charts too, then you have more of a longer time frame. Now, as in the trading world, the longer time frames can be, like I said, we'll be watching the daily, weekly, and monthly. you can't really trade off monthly charts, to be honest with you, unless you're a believer on a particular type of company. We had one of our biggest wins ever over the past 2 years on Chipotle. I was consistently buying Chipotle. I've quite a few of my webinars talked about it as well, probably one of the best ever swing trades, because the long-term signals were so clear that, and of course along the way it fell 30 bucks, 40 bucks, but this is from the $250 to $300 range, okay? And so I still remember being saying, guys, this is a serious money maker. Now, if somebody bought options 6 months out, 7 months out, like longer term stuff, right? They would have done extremely well, but they wouldn't be able to cash them out during that period because you're going to sit on them. Now, this is the difficulty that we run into, is that the short-term picture is very choppy. The intermediate term picture is what we call the swing trades, is showing that the uptrend is good. The long-term picture, which is the daily and the weekly and the monthly, of course, is cuts out all the garbage noise during the day, but also is not something, if you're looking to make and feel good on a particular trade and stuff, not necessarily the best way to go. In other words, they are great swing trades, but they are not something that you can trade off necessarily on a daily basis. Do you understand what I'm saying?
Yeah, I totally get it.
Okay, now
I totally do
let
understand.
me,
Yes.
yeah, so let me keep my thought process going as we do this. So bottom line is, oh good, that stays here. That's great. I thought it was going to disappear when I clicked the screen. So let's start off by patterns. The bearish patterns which occur quite a bit in the market these days is your head and shoulder. The head and shoulder, basically just exactly the way it looks, is it's almost like flipping the birdie, and this you've have seen me put out there quite a bit. I play upon the inverse head and shoulders a lot more, but
Right.
I've also pointed out on my E-mini charts and SPY charts about the bearish head and shoulders. So you have the head, a nice sharp move higher. Then basically there was a lot of sell programs, red candles there, comes down, bounces off support, which is known as the neckline. So this is the neckline, and then it bounces up and goes to a certain level. Now the measurement of how much it would move on a sharp drop down is measured by different methods, but one of the most effective ones that I've found, especially when something goes up really fast or something falls really fast, and then it does that dead cat bounce, that famous old term. Well, the dead cat bounce can be measured through more advanced stuff like Fibonacci retracements, okay? And the Fib retracements, you've seen a couple of my tweets on that, worked out beautifully on the Netflix race just in the last 48 hours. And I mentioned that last night on last night's midweek webinar. It just showed clearly what the chances for Netflix. The Netflix was already making us money yesterday, and today it took off more. So, and it was following that exact levels of these Fibonacci patterns. But that's another day's thing, because that's getting in a little bit deeper. On the surface, the head and shoulder, basically, the stock creates a left shoulder, and then it bounces down, finds major support here, bounces really hard, comes down, moves up, and then fails again. Now, this has happened quite a bit on the SPYs in shorter time frames, and I'll show it to you. And so what happens is, right there, it's obviously not always at exactly the same level, but sometimes it's a little bit slanted. Sometimes it's a bit like this. Okay, neckline's a little bit slanted because in real life, just like in trading, it's not textbook perfect. So then it hits the right shoulder, boom. Almost 9 out of 10 times, you see sell programs come in there. Now, because the market is literally dominated by these algorithmic, HFT, high frequency trading programs, these are written by humans. I actually have some old friends, in fact, 2 of them, who wrote code and still do for some of the large, for 2 hedge funds. Now, the guys don't know much about the stock market, mind you. If you ask them about the stock market cycles and stuff, they have no freaking idea. But what they basically, when they write those codes, they are basically preying on price momentum. Okay, they are basically writing the codes based on movements of prices, and those prices are displayed in the real world in the form of charts. So that's the reason why pinpointing sell zones and certain buy zones and levels that I have shown pretty consistently is easier to see because they are very mathematical. They're very structured. Remember that I use the word structured a lot? So
Yes.
they're very structured. They're not random because the machines are, the computers, they can calculate 1 + 1 = 2, even though it's not like that in the real world, in the stock market. So that's the reason why I can detect these things. And I can draw those lines, and the lines look very symmetrical, and I don't have to toggle them around too much to fit my picture. They kind of just fall into place. And that is only because, it's got nothing to do with me, okay? It is only because the markets are very, very structured. And we're going to, when we look at the SPY chart after this, the E-mini chart, you're going to see exactly what I see. So the first one is your head and shoulder, which is basically a bearish pattern. So it's, and generally if it hits the neckline again, most of the time, it tends to break down. Now, somebody asked me, and this is a normal question that people ask, well, how do you know what's the probability of it breaking down, or whether or not this is going to create a W pattern, which is a bullish pattern, right? And bounce off that same neckline? The only way that on a high probability basis, because after all, trading and options are just a game of probability, right? Like, what's the probability that I'm going to make some money?
Right.
It's quantifiable risk. It's gambling, but it's gambling within a quantifiable level. And so that's the thing. You're not just throwing the dice. You're looking at it and you're saying, okay, this is what it looks like. So probability is more that I'm going to make money, and sometimes probabilities don't work. But generally, it's quantifiable gambling. That's really what it is. So, and especially with options trading. So the bottom line is that the only way, and this is what I have always mentioned, and I have that on my video, but it's, I love explaining this in a very simple way. Everyone gets it. You have the external chart pattern. You have the stock price moving up and down, all kinds of stuff. That's your external, right? So that's the price. Then you have the internals, which are basically all the different indicators that we use. Now, there are certain indicators which are very high probability indicators, which I show quite a bit, especially the slow stochastics. You've seen me write that term quite a bit, and the slow stows, as we call it, on one of my platforms. Man, that's probably one of the best signals I can ever get. However, I track very closely. I track about 6 or 7 of them, and there are about 30 of them out there. The last thing anyone wants to do is to complicate their mind and their charts with 30 indicators. I mean, that's like friggin' crazy. All you need to use is basically maybe 1 or 2, and the most effective one that can be used from an oversold, overbought condition is obviously the MACD and the stochastics. The stochastics are basically the same thing as relative strength index, which is used quite a lot. So those are the internals, which are the indicators. Now, the way I explain it, and everyone gets it, it's like go to the doctor. You go to the doctor, you're a little bit sick. He looks at you. He knows you got maybe you got an allergy, maybe you got a flu. So, he checks your externals, your eyes, he checks your heartbeat, your blood pressure, and all that stuff. Okay, that's great. So that's your price function. But then he takes some blood and he says, you know what, this blood's going to the lab, and let it come back. Let's really find out what's going on. So that is your internal indicator, because that's really what I'm going to tell you whether you're really sick or whether it's just a mild thing, and he's going to, at that point, give you the real antibiotics or whatever else that you need. You understand? So the way I can tell.
I do, but about the indicators, like most, like RSI and stochastics and MACD, all those indicators are calculated based on
price,
though, right?
Correct. The underlying asset root is always the price, right? The price.
Yep,
So what I'm getting at, if I just finish the sentence, I've been pretty good overall in making the higher probability bet, whether something's going to move up or down, based on looking at the internal indicators and then looking at the correlation and going with that. And and given reasonably normal market circumstances, my hit ratio is like 90%. Given volatile market conditions, my hit ratio is going to be lower because of the just sudden movements back and forth. But go ahead with your question, Adam.
Yeah, because I've noticed, for example, like on MACD, you talk about divergences. You look for a convergence or divergence of price.
Well, divergence is only let me point out one thing. Divergences show up very seldom. Divergences are not something that happens all the time. Divergences primarily happen during extreme circumstances. What are extreme circumstances? Big drops in the market or big moves up on the market. But under normal, steady movement up, there's no divergences that show up. So
well,
just
I
keep that in
mean,
mind.
because there'll be times when the market will go up fast, and then the MACD will, it'll be going up, and it'll be widening between the fast line and the slow line, right? And then price will level out, and it might consolidate sideways, and so the MACD will kind of even out and come back together, and then price will go up again higher to a higher high, and the MACD will show a lower low on the MACD because price consolidated, and then so those lines came together. So I've just noticed that a lot.
Now, one of the things, I agree with you. So one of the things that I talked about in my training videos is by the time you actually see a crossover or a real technical buy signals, the market's already up.
It's already moved.
It's already moved 40% of that move. Okay.
Right.
So the bottom line is, I'll give you show you this. Let me pull up a thing chart here. So let's put up the SPX here.
Okay.
And this would be a prime example of what we're talking about. So we're looking at the daily, and we'll clean this out. Okay. So here are the two indicators, which is the stochastics, which I use all the time, has served me very well, and the McClellan oscillator. All right. So the McClellan oscillator is basically the New York Stock Exchange, the NYMO. Now, this is during extreme circumstances. The McClellan oscillator is the best possible signal ever. No question about it. On a shorter term basis, the shorter you put the time frame, like 5-10 minutes, means nothing to me. But on a 1 hour chart, on a 4 hour chart, or a daily chart, or a weekly chart, the McClellan oscillator means a lot, especially when the market's moving around. So basically, when we are looking at chart patterns and stuff, that's a totally different ball game. I am basically a very, very astute and expert candle reader. So that's something that there's nothing to perfect. I mean, I'm always like trying to improve myself. But when I'm looking at a chart, let's say there were no lines drawn on it, just by looking at the candles, I can put a pretty good probability whether it's going to be an up or down thing. So candlestick dynamics is critical. I just have one small video on candlesticks that I found on YouTube. I put that in the new intro stuff, but in the new intro playlist, a new member playlist. But if you got time, just go on Google, YouTube, and type in candlestick dynamics, because candlesticks tell you so much that you don't even have to, you could just be a visual trader, but you have to understand the patterns behind the candlesticks, not just look at the candlestick. There has to be a pattern. So I'll give you an example. So here's a picture of here's a picture of the market from the previous highs, which was back on October of last year, October 2018. Let me see here. Yes, October 2018. This was your climactic bottom on Christmas Eve, right there. And a couple of things where the market is literally a screaming buy, but you have to wait around maybe like, I'm more of a risk trader, so I will start stepping in based not just on this, based on other stuff that I look at, especially on my other platform, the Quad platform. So I will be stepping in at this level, but technically speaking, you can start stepping in within the next 1 or 2 days. But generally, the fastest move comes the following day. And that's what happened on day after Christmas, on the 26th. So simple stuff. If you ever see the full stochastics way all the way down here, and what makes life easier is if you have a previous comparable, right? So if you have a previous comparable as to whether or not whether or not this was a low. And honestly speaking, you normally don't go below 3. I mean, you can't. I mean, you can't go below 0. To be honest with you, I don't know if it's ever happened on the full stochastic. Okay, I think it has happened. In this particular case, it was no. I think yeah, like 0 is 0. That's it. That's it. So if you ever pass comparable, then it makes life a little bit easier. Now here's the trick. On a daily chart, if you see both the McClellan oscillator and the full stochastic, and then every other indicator out there is going to be showing deep extreme oversold condition. But just looking at this, if you see these two things match, you almost have a 80% probability that you're going to get a substantial bounce going forward. Now, the problem with markets are, because of the machines, that bounce will not be validated till 3 days later. You get it? So by the time that it starts moving, that's when you know it's happening. But the biggest move, and this is what they say, they want to flush everybody out, and the flushing normally is called capitulation. You know that term, right?
Yes.
So
Yes.
basically, a capitulation, the way you calculate it, that you normally have a 9-to-1 down day. Always remember that. I'm going to put this down here.
Nine stocks down for every one up.
That's right. And you hear that on CNBC. You can see that on the advanced decline line. So what is capitulation? There is 9-to-1. There is 10-to-1. 10-to-1, 9-to-1 means that there is complete flush out. It is almost, I hate using that word, but almost guaranteed that within a matter of a day or two, you're going to get a very sharp, substantial bounce. But it has to be a heavy volume, 9-to-1 type of down day. So capitulation is the 9-to-1 down days, 9 stocks down to 1 stock up, down day. Generally, all 10 to 11 sectors on the Dow Jones in the red. Okay, so that's another criteria. You need to have you've heard the term AD line, advanced decline line.
Yes.
So basically it measures the number of stocks going, so the AD line should be like a AD line. Basically this is part of the AD line. The most I've seen the AD line is like 6-to-1, like the number of stocks, like 800, let's say 600 stocks up, 3,600 down. These are very extreme readings. So
Yes.
a lot of these things, and the other thing that comes into play is something called, and this is more advanced stuff, but anyway, why not just explaining it to you, is the TRIN indicator, known as the ARMS index. Okay,
I've heard of the trend. Yes.
Now you know that the best resource ever, and they have changed so much from the days they started many years ago, is Investopedia. You need to bookmark that, because I know you got the right questions, Adam, and you're going to pick up things really fast. Investopedia is unbelievable. It is basically the ultimate resource for, I'll show it to you. It is the ultimate resource for anything to do with the stock market, finance, technical analysis, you name it. So I used to spend so much time on that. Even now, Google certain words that I don't know. Investopedia, right there.
Okay.
And you go in there. Nowadays, they started putting more editorial stuff, like opinions from different people, this and that.
Sure.
All fine, which is fine. And then you can type in right there.
Okay.
You can write there. Let's say, let's type in TRIN.
Trend. Yeah,
okay, which was actually, so there you go. So you can basically, what is the TRIN index? It's actually devised by a gentleman who was actually a NASA engineer way back, I think in the 50s. His name was Dick Arms. And it was also known as the ARMS index. So the TRIN indicator basically is a technical indicator that measures, that is a terrific indicator. I mean, it's always there on one side of my screen where the indicators are. I can plot the TRIN, but I don't plot the TRIN. I just look at the numbers on one of my screen. So and I'll tell you what to look for. So the TRIN indicator was Richard Alm, 1967. It's used to gauge overall market sentiment. and it measures the relationship. Okay, so this is what it does. It compares the number of advancing and declining stocks, number of stocks up to number of stocks down, the AD ratio, right? Advanced decline ratio. For example, today there were 834 stocks up for 2,230 that were down. So, and that's why we saw, a lot of red on different sides. But
Yes.
primarily because the banks were down. That's why. So, and then it said, and declining stocks to advancing, and it divides it by the volume. So the AD line divides the number of stocks, the AD line with the actual advancing and declining volume. Very interesting. So here is the way the trend works. Okay. On extreme days, meaning like market down 300-400 points, consistent selling. So the trend, there are two trends. One is a trend Q, which is for the NASDAQ. That's a newer version. And this is for the New York Stock Exchange. So generally, on a heavy sell-off day, the trend will be above 1 plus. Like today, it was 1.04. And the trend Q, the same story. Now, generally what they say is, if the trend ever jumps up, and it does during extreme circumstances, between 2 and 4, that means the markets are probably down 600 points, which is a lot, which is, happens here and there. So basically, the trend will shoot up big time, and that, that's the first sign. Two ways to look at it. It is all depends on somebody's basis on the market. It's a contrarian indicator. If it gets this oversold, that means you're going to get a dead cat bounce, or some sort of what we call in technical language reflex rally, reflex bounce. Like boom, it fell. Now it's going to bounce a little bit. So basically, it's a reflex bounce. So the trend indicator well above 1 means that this is all signs of a major washout in the market. And generally, when the markets wash out overall, they tend to basically bring in new buyers. It's really as simple as that. You know what I'm saying? And they tend to bring in new buyers, or most importantly, when markets drop really hard, capitulation style hard, the shorts who shorted something here, let's say at 10, obviously they're not going to sit around like idiots and say, okay, yeah, now I'm up $8 on my short, because that's what shorts do, right? They're selling $10 and they're buying back at 2 and capturing 8, just the way generally speaking on the long side we do the same thing from 2 to 10. So what are the shorts going to do? They're not just going to look at some beautiful paper profits that can disappear if the market bounces really hard. That 2 can be back to 6. So instead of or could be back to 8. So instead of making 8 points in their pocket, 80%, they're basically going to make 20%, because now they're only up 2 on their short. Do you understand what I'm saying?
I totally get it. Yeah.
So the biggest going back to that other chart, the biggest moves generally happen within 24 to 48 hours. Why? Because like there's an old saying, it's always the smartest shorts that know to get the heck out of Dodge when they realize that the market is going to bounce, and then the buyers come in. So the short squeeze, as we call it, which also happens on a short-term basis, intraday, is generally, the ones that happen intraday, they can disappear the next day, right?
Right.
And we see that all the time. But the ones that happen on a daily chart, those are the ones to really stick to. So going back to what we were talking about on this chart, basically things have to match. There has to be extreme oversold conditions, and then I mix in the moving averages. I mix in the sentiment indicators. I look at the trend. So all this is, after doing this for a while, like, all kinds of naturally, I'm just scanning my head and looking at the VIX, which is a very, very solid indicator on contrary moves. I've shown so many times when the VIX is rising, markets down, I'm like, you know what? It's hitting that level. I show the VIX charts during the day, especially during choppy days. And you've seen that. And I have those resistance level, and it amazes me how they hit those. And right there, you start to see a red candle come in on the VIX, which means the markets are starting to bounce on the other end. And the same thing happened today. So the VIX I read the VIX just like a tactical chart too. So the VIX is a great indicator for me. It's always on one of my screens. And by looking at that, I can pretty much tell whether or not that bounce is sustainable, whether there is going to be a bounce, or whether the VIX is going to continue to shoot up. And I can do all that by looking at my VIX screen. So when every time that I'm showing the VIX chart, just start to get to know it a little bit, because the lines are all drawn, like what the resistances are and stuff. And the VIX is very mechanical. The machines trade the VIX like, it's just like the norm. And by looking at the green candles appearing on the VIX, if they are starting to, and I use the same things on the VIX, Adam. I use the STOs primarily, the stochastics. And if I see the stochastics getting oversold and starting to turn, I know, like I said yesterday, that there's going to be early morning pullback. That's exactly what happened. Like I said it, and within 9:35, boom, they started selling. And I was taking, I took the profits, like, the things we were up on, like, pretty much right off the bat. So somebody said, how the hell did you see that? This answer is simple. I saw it on the VIX, because the VIX stochastics got down to that 0 level. And unless it's going to slide down, it's going to slide sideways, it can happen. But if it starts to turn up within the first 10 minutes, I know pretty much they're going to sell the market right at the front. I mean, it's literally tied hand in hand. And so but then at the same time, I'm looking at the VIX pattern. Somebody asked me a good question. They said, why didn't you go out there and put out a nice short out there? I could have, and I do it time to time, but I didn't do it because the candle structure on the VIX didn't give me the confidence that I needed to put in a nice short. If I buy, let's say, 20 contracts of SPY puts at $1, that's $2,000. That's running with the market. But if the VIX is not cooperating, I'm going to be, I'm not going to lose all that 2,000, but I might lose 1,000 of that within a matter of 10 minutes because the VIX didn't cooperate. In other words, the market didn't fall. Now, to give you the bigger picture, let me move away from this chart for a second. So on this chart, just to recap, these extreme zones are extremely important. Then my structures, I follow them very closely. But go ahead with your question.
Yeah, I'm looking at your chart right here at the currently, not today. If you look at the slow or the full stochastic,
you mean
that slow,
today?
The yellow line.
Yes,
all
sir.
the way on the right, all the way on the right edge.
Here.
That yellow line is, it's starting to turn down. It's been turning down for, a
couple of days.
7 days. 7 days.
So here is the pattern that.
What's that telling you?
Yeah, so basically that's good observation, man, and that's what I'm saying. You got the eye. So basically, what I'm looking at is that's the percentage K line. What's the most important line is the percentage D line, which is the white one. Okay, that's the predominant line. That's the one that leads, and then the yellow or orange line follows. So that's the secondary line. So I'm looking at a couple of things here. This is still in full blast. 1 second. On the daily. So this is cutting out the intraday noise. Is still in this formation. It's a W formation. Get it? So that one is from a standpoint of why. If somebody said, "Hey, look at this chart," I said, "Okay." So what do you think? The first thing I'm thinking, it's not overbought yet. It gets overbought when it gets to these levels. Look, every single time it gets overbought, it can stay overbought, mind you. Look, we got overbought in March, and then the market started rallying. In between a couple of dark days, it just pretty much rallied all the way through May. The overbought condition after resolved itself stayed like that, sideways. So this one is telling me that they probably have one more blast, which I believe, where they're going to take this up to the overbought zone, which I think is going to happen. Like you correctly, we had that nice, your question was terrific question on thing, pretty much right around the time of the Fed rate cut. You get it? So I'm giving maximum best scenario. Maximum best scenario for the overall market is looking at the calendar, is the first week of August. Like that's where we're going to make a substantial top. Doesn't mean we're going to go, well higher, but I'm just saying the market's going to be at that point starting to roll over from a calendar standpoint, the first week of August. And I think we're going to get a pretty substantial pullback sometime by mid-August or so. Now, saying all that, the thing that's holding the market from really coming down is the fact that the level of participation or engagement by hedge funds and institutional money managers in owning stocks is very low, believe it or not. So that's what's holding the stock market from really pulling back. Now, somebody said, what do you mean? So what I mean is this is the way it works. There's a larger amount of bearish shorts on the market, believe it or not, by the big boys who are either sitting on the side with cash, almost $6.1 trillion in cash still sitting in the money market funds. Even that, like I said on the webinar, even what's his name? Larry Fink, who runs BlackRock, the world's largest money asset management company, right? BLK. So
Yes.
he said, and he sees everything. He manages, God knows, $1 trillion worth of money for governments, the U.S. investors, like you name it. He even said repeatedly that he's seeing the lowest amount of stock ownership by large institutional funds. So basically, who's there left to sell? Mom and pop's not buying individual stocks. You know that. Traders are just trading the stocks. They're not owning it. So point is, like, the big boys have not really stepped in. And doesn't mean like everybody, but most of them. So there's a lot of cash on the sideline. So generally, when you have that type of situation, markets tend to just kind of nudge higher, till it sucks in that money, and after that it drops. Okay, so that's one reason, just so you know, why we're not getting a nice fat pullback. But if you look at this chart, let's focus on this chart for a minute here. There's nothing really overbought about this chart, and I'll tell you why. Yeah, we could have a 100-point drop here and there. And 1 second, let me get the arrow. All right. So why do I say that? Number one, this does not get fully overbought till it reaches. That's why I put the green line here, till it reaches the 95 to 100 zone. All right. Remember, the predominant line is the percentage K. I believe it's percentage, yeah, a K line, which is the white one. That's the one that you need to follow more closely. Okay. This is your short-term line. This is your more of your longer-term line. So this needs to get up here in this zone. Number one. Number two, if I look at the external, let me put a MACD in here so you can see. The MACD actually shows some. Let's get this out. Studies, load. Where's my MACD?
Right there in the middle.
Right.
Yep, there you go.
Okay. So look at the MACD here. Let me pull that up. So the MACD is basically telling us that two things. That it's starting, like I said, we are in a topping process right now. Okay. So the MACD,
Right.
like you correctly pointed out, is starting to tell us that, but this is not a one-day process. That's the whole thing about MACDs. Is it's starting to tell us that we were nice heavy histograms were green. We have gone slightly red, and this thing is basically starting to cross over. Now keep in mind the MACD crossed over down here also. It was 4 days of selling. This was back on February. The MACD continued overall moving down. See that?
Yep.
Markets continued moving higher. MACD continued overall to move down. Markets still kept on going higher, and this is over 3 months. So this
Right.
was a 3-month short squeeze and a negative divergence. That the sell-off was going to come, but unless they squeezed the heck out of the shorts, those the institutional shorts, they weren't going to let the market go. And then suddenly they created that fast selling, but that didn't even happen that easily. I mean, if there were a whole bunch of green days and thing, but I'm just talking about, and this was there. So this one was like, if you shorted here and didn't cover here, the next 2 days they actually took away your puts. Like, you're like, what the hell's going on? Then they broke the market. Then there was 2 days of like 100+ point moves higher. Then a fallout. Then a couple of 100 points, and then finally 1, 2, 3, 4, 5 days. Now If somebody wants to really short the market through looking at the MACD as one reliable indicator, here's the trick. You don't want to be shorting around here because you don't know whether they're going to just slam it higher like they tried to do many times. You want to short when the MACD, watch this, look at the cursor, when the MACD is basically breaking, what do we call it, negative gaping mouth, like this, breaking below the zero line, right? So forget about shorting here because that's like high risk shorting. Like next day you wake up, and I've been there and it doesn't feel good. You know, I bought like maybe 20 puts or something, and I'm like, yeah, I'm gonna look at the futures. They were down like 15 after hours. Wake up in the morning, they freaking turn it around at like starting at 7 in the morning, right? And I have to wait till the market opens because I'm not trading futures, and I'm just like trapped. So these type of traps happen a lot these days, and they happen really quickly. And they bust a move on the market 150 up. My puts are like friggin' down 70%. I'm just like, oh boy, here we go again. You know what I'm saying? So so basically the best way to do it over the next following month, we're gonna watch this very carefully, and we are going to do some tactical quick shorts during the day, but to go to bed with a short position, primarily to the SPYs or the Qs or the IWMs or the DIA, the Dow Diamonds. Those are good shorts or calls. They're cheap and they move. We need to wait for the MACD to start expanding lower in a fashion, and the histograms getting bigger, longer on the red side. Got it? So, and because at that point, the MACD is going to take a real nosedive. Watch. It's going to take a real nosedive. There is going to be panic selling, and that panic selling basically what happened in the last leg of the move. 1, 2, 3, 4, 5, 6 down days. So that would be it would be a great. So the MACD would really work out really good on that. And by the time the selling ended, the MACD was all the way down here. There was a minor positive divergence occurring on the histograms, the divergence between the thing. So basically, we're in the early stages of that. We are in the early stages of that topping process. I believe what's going to happen over the next week, 2 weeks, is the MACD is going to continue to kind of move sideways like it did here, right? Kind of move sideways, just the way it's doing now. This will continue for a bunch of days. The market will still bust a move towards the upper end of the rising wedge. 1 second. It's a pretty well drawn chart right there. This is your rising wedge. The max move on this rising wedge, I gotta, if you want to look at it, the max move on, you see the rising wedge, what I'm talking about?
Yes.
That's a major technical pattern. Forget this line here. So that move is
you're looking at like about 30, 50.
That's right, 30, 40, 30, 50. So if you really think about it, it's not that much. We closed at 3,003. Let's call it 3,000. So if we get another 30 points from here, you're looking at another maybe 200 to 250 points on the Dow. That's it. You understand what I'm saying? We already got to 30-30, just so you know. I mean, we got to 30-20. So bottom line is we closed the day down 128 points, 129 points. If in order to get to 30-30, we would need to get back about 300 points. So that means we would get back today's down 130 and add on another 270, another 170 to arrive at things. So it's not like you have that much thing to go. My thought process is there's 2 things happening next week at the same time. One is the Fed rate cut, which we're getting, and the second is the Apple earnings. I think both will culminate on a nice tradable top where we could really hit the market with some nice shorts. But if we're thinking like this, the rest of the really hardcore shorts are they're sitting there like licking their chops saying, hey, here comes the big one, right? So the market won't do it. Because the machines can see where in the matrix of the market, they can see where your positions are. So if they see a preponderance or a cluster of massive, you know the term put call ratio?
Yes.
Yeah,
Yeah.
basically the number of puts versus call. That's published by the CBOE. You can see it for free, the put call ratio on the thing, on the CBOE thing. And there are charts also on stock charts that you can track it. So if you look at the put call ratio, and that put call ratio is like at 1.6, that means 1.6 puts to one call. Those are extreme conditions. So if everybody's betting that we're going to see a substantial pullback, the machines are basically just going to attack the cluster of puts, and then the market will fall a little bit and then ramp up again, and we're like scratching our heads saying, what the heck are they doing? But
See now
that's what keeps on happening. Yeah, go ahead.
with this, I mean, it's really confusing to me. Like with the
There's
whole
no simple answer.
with the
Yeah.
fundamentals, I mean, and not so
Yeah.
much that what you're saying. I'm
Mm-hmm.
just looking at the whole macro thing because
Sure.
tomorrow we have the GDP coming out.
I know.
If it's good, then that's gonna
If it's really good, you're still going to get a rate cut of quarter percentage point, like I explained, but
right.
that will most probably give them, because the market really wants a 50 basis point rate
Yeah.
cut, right? Half a
Yep.
percentage point, which
Yep.
which can happen, but that's like a little bit crazy. That's a lot rate cut. You know what I'm saying? So yeah, initially, if the GDP is very strong, the bulls are going to say, hey, look, the US economy is not going into a recession. This is great news. So initially,
Right.
there might be a quick pullback, but I can assure you they're going to buy the market, the fundamental managers, because they're going to say, look, the US is not in a recession. So
Right.
let's go out and buy stocks. And you know what's going to rally on that? If it's a strong GDP, what's the sector that has lagged big time? US domestics, which is IWM, the Russell 2000, right? The Russell
Yep.
2000 is lagging like nobody's business. I've never seen anything like that. Now, the
Right.
reason why it's doing that, just so you understand, has to do with the makeup of the Russell 2000. The 60% of companies in the Russell 2000 used to be all these little tech companies and this and that. Now 60% of companies are regional banks, and the banks are not doing much other than the big banks. You got it? Because
Yeah.
rates are so low. So
Yeah.
because of that, the Russell 2000 has been bogged down in the mud. But the
Because
bottom
investors think that there's going to be a rate cut, so it's going to make the banks suffer even more, right?
Exactly, and especially the regional banks, they're like, what the hell, So their earnings are hurting. So but there's a lot of manufacturing companies in the Russell 2000 too. There's a lot of little biotechs in the Russell 2000 also. So if we do get a very strong economic number, I have a weird feeling that they will probably pick up on the Russell, saying, hey, that's US based, we're doing good, let's pick it up and run with it. And maybe the big indices, like the multinational indices, which is the spider, might be like, yeah, hold on a minute here. So it's honestly speaking, it's very tricky, because, and that's why I really just focus on my charts, and I'm keeping things like close to the vest, because it is gonna get very tricky. Tomorrow's GDP number, um, and then and the Fed rate cut. Now, if we get a softer GDP, which is really what they're showing, that we might get a GDP of less than 2% for this quarter, um,
Well, then
then
that I think that would be super bullish because I think that would
short term super bullish, but it's hard to read what. Remember, the market used to be like a couple of big players, right? Now
right.
it's like a bunch of heavy duty machines and a lot of players, from
Well,
here
see,
to Hong Kong to Dubai. So
right.
you never know like who's, before it was Goldman Sachs. They used to say Goldman Sachs ran the market and JP Morgan, right? Those days
Yeah.
are way gone. Yeah, they still run the market, but they're not as powerful as they used to be.
Hey,
So
have you looked at the dollar index? Because there is a
not
chart pattern on there that to me looks like an inverse head and shoulders that just basically broke out today.
okay. So let
And
me.
I can't pull up the DX on mine. I
Yeah,
use
my one doesn't show it either. They used to give it
it's
to
weird. It
us.
used to, but it doesn't now. I use
So,
UUP.
oh, you use
UU.
UP. Yeah,
Yeah,
hold on.
that's
I
the
do have something. Yeah, they these bombs. They just take away some of these things. I had it here.
because it used to be backslash DX was the dollar,
Exactly, backslash DX,
and
and
then
now they can. Okay, so what if you type in US dollar? One second. So Japanese yen spot, Swiss
Yeah,
franc
then you got
spot,
the,
US dollar rand spot. So we'll just use USD. Okay. So this is your
that's
what is
that's
that?
semiconductor.
That's not the dollar thing?
No, that's
Hold
not
on
the
1 second.
dollar.
I remember the UEP from way back. Okay, US dollar. Let's see what it's showing. 1 second.
Okay.
Okay, so we'll just stick to the UEP. Okay. So basically, this is your daily chart, right?
Yes, sir.
So this is definitely, if you just look at this, that's an inverse head and shoulder. That's an inverse head and shoulder of
Yeah.
right there.
It
See
looks like a
that?
pretty clean
And
one too.
and it broke out. Wow. Now, let's look at the weekly. So the dollar at the highest level was here. Now, the
Yep.
other reason why the dollar's breaking out is not necessarily, honestly speaking, with them cutting rates, you would think the dollar would fall, right?
Yeah, but
But
Europe is going to cut them faster though.
that's right. That's the problem.
Yeah.
Europe's rates are so horrible that they're all buying US dollar denominated assets, you know?
Right.
And the other reason the dollar's going higher is because a lot of big foreign money actually likes our dollar denominated assets in stocks too. And then they buy our bonds, right? So they
Right.
have to pay by dollars. They keep on buying up the dollar. But
Well,
this is
see,
definitely, tell me.
another thing, looking at this chart, I remember back in early this decade, the carry trade, the dollar went down, and
Yes, yes.
stocks were going up. Well, now if you look at the charts, the dollar's going up and stocks are
And
going up.
stocks are going up. The carry trade used to remember, and that was the carry trade between the dollar and the Japanese yen. I used to
Yeah.
track it so closely, whether the yen was weakening or strengthening, right? And you
Right.
correctly pointed out. But now the tables have turned.
Yeah.
The tables have turned. That's why the bond guys are scratching their head, like, what the hell? Like, with bond
Yeah.
rates like this, which is at 2.07%, they were up a little bit today. 10-year government bonds were up 1%, 1.17%. They're all like predicting some sort of massive recession, but yet you have second quarter earnings now in full blast. We are having one of the busiest earnings week, and more than 75% of companies that have delivered have now basically beaten the lowered estimates. You know what I'm saying? So
Right.
it's like, what gives? And then you get companies like Intel saying, no, things are okay. Stocks up, we played that on
7%.
earnings. Like, great. Texas
Yeah.
Instrument, which I missed yesterday. I wanted to slap myself. Like, what the
Yeah.
hell?
Starbucks.
Starbucks, like, what the hell
Yeah.
was that? I mean,
Yeah.
purposely, I thought of it. I'm like, yeah, should I put Starbucks as the play by like a couple of calls? Like, and I'm looking at it, it's up like $6. I mean, it's sick.
Yeah.
That's it. That's a huge move. So yes,
Right.
you're absolutely correct. See, you because you've been doing this, like, you understand the macro part of it. What I am basically, and now I'm going to go back to the other chart. So what I'm going back to is, if I start to, because I'm like you, like, I like to think like the bigger ideas and stuff, right? So, but the problem is that it doesn't pay the bills that much. Like, yeah, we understand the bigger idea. I explained that in short, in short bursts, on my webinar, so everyone's kind of informed, like, what
Yeah.
the macro picture is. But the macro picture doesn't dictate the markets anymore. And that's the weird part. There's like a completely different type of correlation. Before, it used to be that when oil shot up a bit, the markets wouldn't like it. Remember that? Like,
Yeah,
if oil
that
went
was
up
like
2007,
2006, 7, 8.
yeah,
It was an inverse correlation,
yeah,
Oil would
it
go
was. Oh
up, the
no,
markets
as
would go
recently as like three,
down.
4 years ago, and now it's like, forget it. The oil rallies, the market rallies.
Yeah.
Because but then oil's like not super expensive either. I guess there's a threshold after which they start getting really worried because there's a glut of oil. Let me go to
Yes.
the SPY chart, but before that, let me just run through. So you know this well, which
Yes.
is your. Let me change the pen color. Bearish head and shoulder. Understand that. Rectangle, simple. This is trading range stuff. Number stocks trading in a trading range. It doesn't necessarily have to come down. It can always break out. You know what I'm saying? So and again, watching the internals and all the different indicators, which we kind of touch base on. So those are the ones that we have to watch to see whether or not this trading range is going to be up or down. these are this they're calling, one second. They have all these different names for it. So this one they're calling a channel, which is a stupid name. Bottom line is this is a consolidation channel. And generally a consolidation channel is formed when you're coming off way off the bottom, zigzagging your way up, okay? And then there's a bunch of days of profit taking. We just looked at it on the SPYs. You know what I'm saying? It happened in May. It happens every couple of weeks. So this is the part which gets tricky because you can make money off this move as it's pulling back, but generally again, the indicators become very important. Internal indicators become very important to figure out whether or not this is going to break out like a bull flag, or whether or not like this, like a bull flag, which has been happening quite a bit, or if it's going to break down. Because either way it can go. But generally speaking, the market tends to stay within the primary trend. The primary trend is still higher. But the thing that I like to warn people, because we live in a completely different age of these high frequency trading machines, that the primary trend can change in one day with a 700-point drop. It's happened before, right?
Right.
So we have to be, again, the 700-point drop doesn't happen in like 1 minute. So I'm always keeping a very close eye on the VIX. The VIX is going to tell me whether it's going to be a 700-point drop or whether it's going to be a 100-point drop, which will turn into a 100-point gain. Do you follow what I'm saying? So anytime that I'm putting the VIX charts out there on off my quad platform, very easy on the eye. There's a bunch of them today. Like before you go to bed, like, take a look at it. I have the lines drawn both on the 1 hour chart and the daily chart, and they tend to follow the 1 hour chart for short-term trading. And of course, the daily chart is a different story. On the daily, the VIX is gonna explode very soon, higher. Like we're literally gonna explode up to 17 and 20, which means the market's gonna drop about 500 to 700 points. But like I said, that's most probably gonna happen, which you agree with me, probably gonna happen sometime by
Next month,
mid-August.
probably, right?
Next month, yeah, absolutely. And it all falls in because I'm looking at the daily VIX here. This is like they're gonna chop it around this level between 12 and 13, blah blah blah, and then all of a sudden, they're just gonna move it up 15, 16, 17, and it's gonna happen very quickly, because my 50% Fibonacci retracement on the VIX with the high at 36 and the low at around this level, 12 or 11 was the low actually in end of April. The 50% Fibonacci retracement, I wish I could show it to you, it's my other screen on my other computer, is 23.6. That's 24. So, and that happens to be, and this is what I love about it, that happens to be the peak on the VIX when we crashed in May. The VIX had shot up to 24. So I can put money down, we're going to go to that 24 or close to it, but we just won't know. Like we will start to see it, but they're going to move it very sharply. There'll be a couple of 300-400 point down days. You know what I'm saying?
It seems like the VIX it's jumped up and it's been consolidating higher.
Yeah. See, what I do,
even though the market's going higher, the VIX has stayed.
The VIX has stayed
elevated
in this range. Yeah, the VIX. But then the other people would say that the VIX shouldn't be at this level. It actually should be higher. You know what I'm saying? But hey, look, with Boeing getting hit that hard the past 2 days because of the earnings and what they said about possibly taking out the 737 out of production, you think that the VIX should be higher. But then it's what the guys in the market do. They just shift the money to other areas. Like 3M was up a lot today, so that's a major Dow stock. Now McDonald's is up $4 after hours. So they basically negate the effects of some of the other Dow components by just moving it into some other ones that are going through the roof. I believe Intel is a Dow component too, right? Even though it's on the NASDAQ. Yes. Exactly. They added it a couple of years ago. So there you go. So they keep on moving around. So let me just go through this. So that's your bull flag. These are the triangle patterns similar to bull flags. Generally speaking, the price action is all profit taking after initial run up, whether it be a couple of days or whether it be a week, depending on what time frame you're looking at. And then the profit taking comes in. So that can be in the shape of this consolidation channel sideways. They can look like this. These are the most bullish bull flags, the ones that face up.
That are rising, yes.
That's right, rising bull flag. These are the ones which are trickier and have to be monitored more closely. These are the ones which are easier to trade because we know exactly what the trading range is. And then these are the ones which are the triangles. I find them to be a little bit more difficult to read because this triangle can resolve very quickly lower like this.
Yep.
So
And that bottom
but
one is what gold is doing right now.
now what? Oh, because I don't track gold anymore, so that's why. So this is another very bullish one because this is an ascending triangle with a flat top, and it squeezes up, and boom, it goes. That happens to be a very high probability one. This is a descending triangle. In a bull market, descending triangles generally tend to be low probability moves. Somebody says why? Because this is what happens in a bull market. Instead of the descending triangle breaking down, it transforms itself into a falling wedge, which I've shown many times. That
Yep.
falling wedge, when it breaks out, the shorts just basically get obliterated, especially the ones who came in here. They and I've explained this in my previous videos. The ones who shorted think, oh, look at this. This is a descending triangle, and the volumes, the volume's pretty good. They're all selling, and all of a sudden they just turn on the monster buy programs, and it moves up, and that is your wedge reversal, falling wedge. These falling wedges are very powerful move. You can make a real decent sum of money over a short period of time, and when I mean days. And you want to get the heck out of Dodge because once it moves up here, then it starts to hit some major resistance levels and it becomes a trading range. Again, now we don't know whether it's going to come down or not, but the best money to be made is on the breakout. Now, what I tend to do is I tend to push myself a little harder by reading a lot of other internals to determine whether or not this is when the falling wedge is going to about to happen. And if you're in there before the breakout, you're obviously going to make a crap load of money. We did that with the SPY in the month of May. And one of my webinars, on Sunday webinars, we talked about it. And within 48 hours, that falling wedge just broke loose and the market went nuts. So you can kind of see that. It kind of dawdles around. It looks exactly like that on the chart pattern. This is a double top. Well, we know that stuff. W formation, also known as a dragon bullish. Basically, you get a pretty confirmed double bottom, and you tend to get a W formation. That is exactly what I posted over the last couple of days on the market, and that's exactly what happened. On the SPYs, this W formation. This triple tops, those are high probability breakdowns because if you can't take out the triple top, you're going to take out the bottom. It's almost a given. The same crap with the upside. If you can't take out the triple bottom or triple support, that means they're going to run it higher. Okay, so these are the basic ones that come, and then of course you have the more interesting ones like the cup and handle and stuff like that, and that's what we look at, and we will call it a day. So let's look at this. What happened to it? Disappeared? 1 second. So I read this chart really well. So here we had the big, we were moving up. We moved up really hard from early July. This was the 10th of July. Where is the month of July? So this is basically the month of July. It gets faded out. But anyway, so we had a big move up, ramp up. The market edged its way higher, and then we hit the 3,000 level, right? And I had projected on my other stuff that we were going to hit around 3,010, 3,020. Lo and behold, we hit it. I'm like, wow, look at this. Okay. Now, the minute we hit it, they started selling it. Okay. It's a round number. They started selling it. So at that point, we went into the 16th of July, and generally the middle of the month is a lot of technical adjustment and options and stuff like that. Big portfolios, you tend to get a lot of volatility. And then we had that nice fat flash crash, which was on the 17th. What day was the 17th? 17th was last Wednesday. So you get that big fat crash, creates huge oversold conditions, and within 1 day, which was Thursday 18th, we get a absolutely humongous rally that takes back everything that we lost on Wednesday, right? So
Yep.
you get, bang, you get a double bottom here,
Yep.
by the way,
Yep.
and you
Double
had a
bottom.
massive double formation. This is the part that I get really confused in, because I can't read that. This part,
Right. Because
because
that
here,
looks like a bull flag forming right there.
yeah, that's looking like a bull flag. The market's moving like a maniac. This is the 19th. What day was the 19th? This was the 19th, was Friday. It's just like, pretty, this was the morning of Friday, and then comes the, one sec.
Yeah, I do. I remember that. Because
And
what was that? Yep.
the this is the 19th, 9:15, market opens, bang. Now, I can't remember exactly because so many things are going on. What propagated that sell-off? Oh, it was I think it was one of the tweets that he's not too happy with the Chinese. You remember that? He said, like, I used to like him as a friend, but I don't know, I'm not sure yet,
Yeah.
that type of stuff. And then next thing, like, see you later. So this type of volatility is just insane, but we got to get used to it. And more we attack it, and this is obviously a 15-minute chart, so you're seeing every little nook and cranny of what's going on. But
Right.
the bottom line is, once we got this double bottom, this is when I could actually draw my, I once in a while, I don't use it too often, this Gann box. The Gann box are very similar to, and you can look up the definition in Investopedia. It's very similar to the Fibonacci retracement, this box. So this box I just put yesterday, but this one was the one that I was playing on, because at this point I had a bunch of things going on. I had 3 reference points, correct, on the top
Yeah.
end. So I
Yep.
knew this was pretty much the top end from a trading standpoint. I had 3, even though it slipped below that, I had 3 support points. So I know that regardless of what happened, at least I knew that this was the big fat trading range that the market wanted to follow. So stuck with that. So once I started to do that and I started to draw my lines, I put the Gann box, which automatically gave me the 50% retracement, which is standard procedure with Fibonacci retracements, especially on big pops and drops, right? If you move up a lot, it's going to
Yep.
come back and test that. You move down a lot, it's going to come back and test that. That's your 50% dead cat bounce, all right? Just take it for what it's worth. So then I had a structure. So I started structuring the chart. I started drawing my lines. See the falling wedge right there? There's your falling wedge. You see, I normally draw the falling wedge, just in this pink or magenta, whatever you call it. All right. Any wedges I tend to draw or this color. I like to stick to certain colors. Got it? So
Yes.
even though I drew this channel with the same, generally speaking, most of my channels are drawn in blue or green, like this. So just things which which more you get used to the chart, you'll see it. So now I had a structure. I started putting that. Bam! When it started to go, I started drawing the uptrend line. I saw how it hit by the 22nd, which was Tuesday. I saw how it hit the 50 retracement level. I was telling people buy the SPY 298, 297, 298, 298, 300 calls. Internals were starting to really turn up, which I'm not showing on this chart. By this time, basically, I could actually draw a cup. So the first cup that I drew was this. See that?
Yep. And then it has a little
And
handle coming off to the right.
the
Yep.
first handle that I drew was this one. This one. So the first handle that I drew was this one. Now at this point, I also knew that this was one of the necklines, and that was your ultimate neckline. I did not expect the market to bust a move over this box from Tuesday. So what I did was I drew this handle. I noticed how it just came down, and this is the beauty that I like about trading off charts. Now I wasn't trading like crazy, like every 10 minutes or 15 minutes, but just like setting up positions, doing a couple of day trades that I do on the side. So I noticed how it came, retested the 50. Remember, this is the 50 line, right? It bounced there twice and then just took off. So it hit the upper end of the handle. Actually, I hadn't drawn this handle till I got this. No, I had drawn this handle. So at that day, it's right there. So then I noticed how the internals on stochastics and stuff were just like rushing. They took out this handle and just went berserk. Now this I think happened overnight. No, it happened at 1:30 in the afternoon. And this had to do with the beige book and stuff or something. I mean, there was a lot of stuff.
Yep.
I know it was beige book, and one of the Fed governors basically saying, "Yeah, we should definitely cut rates," and stuff like that. So the market just said, "Okay, time to squeeze the shorts." So they took out this handle. Once it went up here and hit the upper end of my, see that? That's your neckline.
Yep.
Upper end, upper. It says range trading. That's basically what it is. I at that point drew the second handle. Lo and behold, the market hit that and went straight down and retested the midpoint of this consolidation. This is a consolidation channel. These are all consolidation channels. And what amazes me is that I had drawn this line. I noticed it touched that, retested this. And what amazes me is how accurate these structures are. And like I said, I'm not the kind of guy who say, "Oh, I know it, that's why I put it there." No, I just draw very well. So when I'm drawing these structures very well, it just seems to be that the algos are programmed to follow those structures, right? Otherwise, I could never draw charts like this, Adam. You understand what I'm saying?
I get you. Yeah.
Yeah, because they're so structured. In between all this noise, I can still draw the thing. And the more you work with me, you're going to see it, and you're going to start putting some of these structures together. Because now I have got two things going. It's bouncing off the mid consolidation level, and it is now within this large uptrend. Get it? So now I'm like, hit the gas. So about a bunch more SPY calls, and then it just took off. I had no idea it was going to do that. Okay,
Yesterday was crazy.
Yesterday, yeah. So then it just kept on going, busted another major move here, and then I had a doctor's appointment to take my wife. That's why I was gone for a couple of hours this morning, and then immediately they started selling, like automatic, right? Bang, bang, bang. Yeah, they blame it on Draghi and what he said and stuff like garbage. It was just, there were some earnings hits too, right? On Tesla and whatever else. Xilinx fell.
Right.
Yeah, that thing's going to go out. We cut a deal on Monday or Tuesday because our treasury secretary is down there. That stock is going to be up to 132. I've traded the stock so many times over the years. That stock is going to be like 135, like head spinning. It's the only reason they said the guidance was a little bit soft. They said yes, because of all the trade issues with China and stuff. They're being conservative with their guidance. Aside from that, stock was only down 4. That's like on a normal day, the stock would be down 4. So I actually liked it a lot. I bought some cheap calls for next week after being down on my initial calls on Xilinx from yesterday. And I'm almost break even, almost. My cost basis I think is about $1.50, and the calls closed at $1.02. So I'm okay with that. So anyway, immediate selling. So this is the part, Adam, while we're covering this, it's so important to keep in mind. This type of selling that just starts, unless somebody's watching the charts, there's no frigging way to predict that, because this is a immediate flash crash,
right?
Which is just happening fast and furious. Yes, then somebody says, well, how can you predict flash crashes? Nope, I can't. That's why they're called flash crashes, okay? I can say that, okay, it's way overbought, needs to pull back, but to suddenly let the floodgates open and just drop everything, it obviously came down, retested the neckline. See that?
Yep.
Tried to hold that, slice through it. Here's your second neckline. Tried to go above that, failed again, hit that, comes into another pattern. Head, left shoulder, right shoulder. That's why I had those bars there. See that?
Yes.
I even put that on my thing. Now, somebody says, well, how the hell do you know it's going to hold it? I said, listen, I don't. All I know, I've seen these things happen a lot. And it's almost like magic that they tend to hold, especially on this big thing. So here's your pattern. Very large. Here is another shoulder. A small one here.
It almost looks like a fake breakout. right there, you know, like,
Correct. But one thing I've learned is not it's like every move, up or down, they're both fake. Except the stronger fake, for a better choice of words, Adam, is the primary trend being higher. Because how many breakdowns are fake? Almost every breakdown that happened in the market is a fake breakdown because it never cracked the market. That's why we're at new highs.
yeah,
But what you're saying is correct, that this move was a fake breakout. Correct. They just squeezed the shorts, and then just let it go. Yes. So this one, I would agree with you. So anyway, so this is still a head and shoulder, and I had and look what it did. This is like, I even pointed it out because people have to see how accurate these
because
things
it
are.
did bounce right off
It
the top,
hit exactly.
channel.
Okay,
Yeah.
see this line? This line. Let me
Yep.
make it a little larger.
Yep.
That's a downtrend line within the
Yep.
first box, right? Not this big one. Not this big one. Let me make that a little larger.
No, I see the one you're talking about,
You
though.
see that, right? So you see
Yes.
this, you see this. So this one, it hits that, it hits the cup and handle breakout, boom, takes off. So let's enlarge it. So there we are. So now it actually is printing with futures up about 3 points. Believe it or not, it's above the major downtrend line from the 14. Oops, sorry.
Yeah, it is.
Where is this doing this? One second. I was trying to get it. I was just trying to make it a little wider. Anyway, I can't. So see that? There's your big downtrend line. It's printing above that. So this is my guesstimate. This is you see everything now. So this is your rising wedge, correct?
Yes.
Right there. They call it a diagonal, and God knows what else they call it. I just call it a rising wedge. So here's your rising wedge. What do rising wedges generally do? They pull back. They go like this, and then they have that consolidation phase. Primary trend is higher. After a couple of hours, a couple of maybe a day or two of consolidation, it continues on the primary trend it's coming from. That's just a general technical pattern. You're with me so far, right?
Yes.
Okay, so here's your big rising wedge. We went to the top of the rising wedge and we fell out of it. Standard behavior, nothing to be alarmed about. Yes, might seem freaky that boom, markets fall like 80, 90 points, some headline coming out. But if you look in the context, of what this is, it's just a rising wedge and they took it down. Now in between, I have those lines drawn where the supports are. So they hit exact support, and now they are moving the markets higher, right? Rising wedge, sharp pullback, retest, and now they're doing this. So here's your rising wedge, sharp pullback, and now they're doing this. So in other words, classic standard stuff. Now, question is that this is where technical analysis gets a little bit tricky. It also depends on how one is looking at the chart. What is this pattern you're looking at, Adam? 1 second. And I'm trying to get this thing bigger. I don't know why it froze me. Okay, what is this? I'm going to draw it out for you.
Oh, you see it like maybe a Head and Shoulders is popping
That's
up.
right.
That's
right. Exactly. So now it's a head and shoulder. So unless we bust a move over this, that means unless we re-enter the rising wedge, in which case we can overshoot up towards 330.25 again, this still remains a head and shoulder with a neckline at around these levels. See that?
Yeah.
Exactly. So if you see the market pull back on the way these charts can predict certain things. That's well. 1 second.
So you got to get back.
So here let me explain.
12, basically.
Okay, so here's the point here. This is 3,000, right? 29.97, roughly 3,000 on the S&P, right?
Yeah.
So there's your big neckline, also a psychological number. So here's the point here. If tomorrow pre-market jobs numbers comes out, initial reaction is always the false one, generally speaking. You know that, right? I mean, the initial reaction is
Right.
always the false. If we're up 200, sell the crap out of some of the things that are going to go higher because they're going to pull it back. So if it falls 200, you got to be tactical buyer
Right.
depending on the charts. Because generally speaking, the market is fixated in only one thing. The Fed, are they giving us that 25? Are they giving us the 50? So in between, these numbers really, in the bigger scheme of things, don't really matter, you know, unless there's something dramatic happens, like we created 500,000 jobs. I'm just giving you some fairy tale. I mean, you know, or we created 50,000 jobs, which can happen. You know, you never know. I mean, the Labor Department's freaky. So the bottom line is it can come down really hard pre-market. So we could be losing like 10 points from where we are right now. We are right now at 3,009. So we could easily come down to 3,000. So as futures could be down 10 pre-market, right?
Sure.
But it means nothing because the neckline, if it still acts as formidable support, and we can see where the support is right there. It also happens to be the downtrend lines. It also happens to be where we bounced off from on the cup and handle breakout. So if we don't break this, then that would become an inflection point to buy. So in other words, it would look like this. If it doesn't break, if you break it, you can short it down. Shorting is tricky because there's so many support levels below this. You know what I'm saying? But still,
Right.
it would be a short. It'll be a bearish move. But if it starts to bounce, it's going to do this. And if it, you know, either that or the market's pre-market, they like the job numbers, whatever they do, you know how it is. And then they run it into the rising wedge, pushes it all the way here, maybe busts a move just to squeeze out the remaining shorts at that 30.27 level, right? And then what was the high on the S&P today? It was 30.1959 year high. That's not the year high. No. It was 30.16. Okay, so 30.16 was where it went to. So the bottom line is
I had 30.27.75 on futures.
on futures. Yeah, that's
Was
different.
yesterday,
Yeah,
yes.
exactly. Yeah. So bottom line is those are the two scenarios that are going to happen. They're going to bust a move down here, retest this. If things are really, let's put it this way, the big boys take it really negatively, then I can assure you, and that's why this chart is so critical for this week. I can assure you, if they really hate it for whatever the jobs numbers are and stuff, I wouldn't be surprised if we go back and retest this again.
Yeah.
You know, along the way, it's going to kind of like slog around and get fake little moves, you know, short covering, but it could happen. Now, if this holds, that creates a really powerful platform for a substantial move early part of next week. You understand what I'm saying? Because at that point, we got a triple, quadruple bottom here at the 29.70 level. Then that becomes something like this, Adam. Like a really big.
Yeah. I'm looking at the chart right now on my phone, and it's you got like the M top, look, the double top, look right now, but within that, you know, you
I
have
mean,
the
honestly, I think this zone here, look, I have another line drawn here. Why did they freeze me? Hold on. I'm trying to drag this down. Oh, this is the hourly chart. Forget the 15-minute for a minute here. The hourly chart was oversold. It's, you know, it's just starting to move up as we speak. Futures are up 3.5. This is telling me that this is really what I'm thinking. Best case scenario, we get to 30.40, and that's the upper end of the channel. That's when you get that big ascending triangle breakout stuff, big time. You know what I'm saying? Like really big time. So, and that ascending triangle would be this. Watch. There.
Yeah.
There. You see what I'm saying? Look at that. It's like
Yeah.
a big V, but this is your ascending triangle.
Because you got the shorts who are shorting it up by 30,
Now,
20.
the guys who keep on like, I don't know what they do, okay? If they keep on shorting and this enters this ascending triangle, they're going to one way or other just artificially create a fake fat breakout that's going to take us into the zone. And that could happen tomorrow. Otherwise, we know what can happen on the downside. Now, this is an hourly chart, so we can see it more clearly. There's your thing going on. So there's your W. So I'm still looking at 29.73 if all hell breaks loose. Here's your flip the birdie. Right? Yeah, exactly. There's your flip the birdie. There's your neckline, 29.92. Breaks that. That's why I put these little boxes in there. It looks pretty funny. So this is like, don't cross the border. All right, or we're gonna shoot. So that's it. No crazies coming over. So and then that's it. And in between, it could even do that. So I'm going to be watching this chart. So when I'm putting this chart out, I put a pre-market thing. I'm going to be putting out, within the first half hour, in the first 15 minutes of the market opening, I normally put out the 15-minute, and then I put out the 1 hour. The daily, this is your daily chart. This is what I was talking about. He's really not giving us a heck of a lot of indication what's wrong. I think the investing.com server, that's a daily. So daily is not giving me any indication, really, honestly speaking. I mean, I can see what's going on, but if I'm trying to trade these candles, I wouldn't know. I mean, this helps me. Look, it's still a bull flag. It is still, if you want to look at it this way, the bigger picture, moved up a lot, and now we are in this consolidation. See what I'm saying? Yep. So this is why it's hard for me, just so you understand. This is why it's hard for me to get decidedly negative, because I will get decidedly negative if we break below, like I said, below where the structure changes. So here's your structure. Here's your rising wedge, a little pullback, and a consolidation channel. If we break below these lines here, let's say, and I was looking at it the other day to see if we could break and stuff. 29.58, 50-day moving average is 29.18. If we break below this, because you trade futures, keep this in mind. If we break decidedly with a nice fat red candle, break below 29.52, we are inevitably going to go back and test the 50-day moving average. You got it? So you got 40 points in there. That's a lot of money. But whatever's going to happen is going to happen real fast. So will it happen? Nothing is indicating it will, because even the this was what I had predicted. Oh, you'd be impressed. This was before you joined. So this is what I had predicted. I still have it drawn there. See that? So I was predicting
the falling wedge on the stochastic.
Exactly. And somebody said, you're drawing a falling wedge on the internals. I said, what the hell? Why not? I've done it before. So, and boy, was I right. So this was during the really ugly time in May. So I started drawing the falling wedge around this time. And I said, you know what? This can really deep oversold. I drew it. And then lo behold, three days later, on the 3rd of June, when the market bottomed, it just took off. I'm like, yes, yes. Now, I also tend to be somewhat cautious. I used to, because of the volatility in the market, I trade pretty aggressively, but I'm also cautious in the sense that if I bought something off the falling wedge and prior to that, I tend not to get the full performance of the 4 big candles. I'll take profits along the way and move the strikes up, right? So that takes away from some of my gains. If I just bought it, held my nose, know it's going to happen, that's a different story. The bigger the position I have, the more scared I get, because the more profits I have. I do not want to go to bed with that profit and the next morning take it away, because it just happens too often in these type of markets. You understand what I'm saying?
I've gotten into that too, where
but
you get gun shy because you'll have like a nice gain,
and then it just takes
you
away.
hold it wanting more, and then you lose
so
it.
Here is the trick. Just even at this level, still tend to be biased long and leave a little bit in there, because the next morning, you can sell it, but don't go in there with heavy duty stuff. Now, have I left a substantial amount of table despite some great performance on a real decent money this whole year on not holding large positions and dwindling it down before going overnight? Yes. Does it piss the shit out of me? Yes. But hey, what to do? But that's what, so this is why I'm saying while the market has a tough time crashing, because even bulls like me are not being aggressive. We're not playing offense in a big way.
Right.
We're playing offense in a small way. You understand what I'm saying?
I
The
get you.
only
Yeah.
big positions that I keep holding are my long-term swing positions. I just keep on piling it and just leaving it in there. But so Adam, this was awesome. And like you said, there's a lot more. There's a lot more, and just start tracking the charts and stuff. And at some point, if you want to sign up for the ACS group sessions, I'd be more than happy to work with you, because there's quite a few other things out there which you can apply and do well. But like I said, just go through what we have out there right now. Ask me a couple of questions here and there, because you do know the macro picture, and then we can see what we can do about the ACS sessions. Fair enough?
Sounds good.
Hey, listen, give my best to your family. God bless you. And this was long, but it was really fruitful. So thank you again.
Thank you so much, Frank. Take care.
No problem. And pass the word around. We always like good referrals, right? So
For sure. Yes, sir. Absolutely.
thank you. You have a
You have a
great
good
night.
evening, sir.
Bye-bye.
Thank you. Bye-bye.
This conference will now be recorded.